Hello, welcome back guys. In today's video, we are going to be talking about liquidity zone, specifically internal range liquidity and external range liquidity. This topic might sound complex at first, but by the end of this video, you will see the market very differently. If you've ever asked the question, how come the price has to spike here and reverse? Why did the market ignore my entry and just run stops? Why does price always move to those obvious highs and lows? The answer to the question is liquidity. So let's break it down step by step. Liquidity refers to where buys and sell orders are concentrated in the market. So think of liquidity like as fuel. The market cannot move without fuel. Banks, institutions, and big players don't just enter trade randomly. They need buyers to match sellers and sellers to match buyers. So they look for areas where a lot of orders are set. These areas become what we call liquidity zones. So liquidity zones are those specific areas on the chart where there is a high concentration of buy and sell order. When price approaches these zones, you often see sharp moves, strong reactions, fake breakouts, and stop hunts. Because the market is doing what it always does, it's collecting liquidity. Going to those areas, collecting liquidity. So before we go deeper into understanding external range liquidity and internal range liquidity, let's understand what a range is. A range is formed between a significant swing high and a significant swing low. These are not random highs and lows. They are important because they usually look at previous liquidity level that are taken out. They cause strong reactions in the market and they define the current battlefield of price. So when you are understanding what a range is, if we look at market structural movement, the impulsive move is what is called our current battlefield, current trading range. The swing high and the swing low, that's our current range we are looking at the markets at that point. This is our current swing high, and this is our current swing low. So from the swing high to the swing low is our current trading range, the current battlefield that is giving us the move that we should trade from. So this is our current battlefield of price. Everything that is inside this, from the swing low to the swing high, is what we call our current trading range. So if the market does a pullback, remember our Fibonacci premium and discount, the market is bullish. We need a pullback to get into a discounted price and moves back up again, breaking the previous swing high. We've now gotten a new swing low and a new swing high, giving us a new trading range, which will now be our focus area to look for pullback and a continuation to the upside. Give us a new swing high and a new swing low. This is our current battlefield where we will look for entries then to target either the previous high or the previous low. So that's understanding range. The significant swing high and the significant swing low gives us our current battlefield of price, our current range. So once this range is established, everything we do is based inside or outside this range. And this is where internal range liquidity and external range liquidity comes in. So looking at this chart, the move that happened on this chart, if we are looking at this as our current, the lowest point in the market, where did the move start to give us this move down? This is the last lower low that we got before we got this. So this move propelled from here. This is the last lower high that gave us this move to the downside. So price moved up, took out this high. We got a break of structure. This is now our current trading range, swing high and swing low. Price pulls back, gets back up again, taking out this previous swing high. This is our current swing high, our current trading range. Price pulls back, takes out the high. It gives us a new swing low and a new swing high. Yeah. price pulls back up again, giving us a new swing high here and a new swing low here. We get a pull back again. Price swings back up, giving us a new range to trade from, this low and this high. Get a pullback, price continues like that. It continues moving like that, targeting those ranges outside the previous swing highs. If it takes out the previous swing low, we start looking for opportunities to the downside. So that's the range. Every level taken out gives us a new range. Every high or low taken out, if the market is bullish, it continuously taking out highs. It's giving us new ranges to wait for pullback and continue in the direction. External range liquidity. External range liquidity refers to liquidity that exists outside the defined trading range. Liquidities that exist outside the defined trading range. So we have levels like previous swing highs and previous swing lows, and obvious highs and lows beyond the current range. Obvious highs and lows beyond the current range. These areas are extremely important because they act like magnets. The market loves to move towards these areas to trigger stop loss, fill pending orders, and generate volumes for large positions. So when price is inside a range, one of the first questions you should ask is, which external liquidity is price targeting? Which external liquidity is price targeting? Using the same chart, price has given us a new range. Since it is a bullish swing, a bullish range, we anticipate that price is going to take out swing high, which is going to be our target. So once price does a pullback and gives us an entry point, price moves back up, taking out the previous swing. As we are in a bullish trend, the swing high is our external range liquidity. The swing low is our external range liquidity. So other lows, other highs, previous highs that are by the left are target areas also for swing external range liquidity. Other levels that are outside the range are also external range liquidity. So price moving up, taking out previous swing high, we get a pullback, the swing low not taken out, is targeting to take out the next external range liquidity, which is the previous high. So price takes it out, pulls back, the next target will be this high. It takes it out, we continue like that, the high is being taken. Price is targeting this level because these levels are acting as magnets, drawing price to itself. So once we are in a bullish trend, price is targeting the swing highs as this external range liquidity to get orders. So if you are in a sell trade, your stop loss will definitely be above this high. So price is coming to pick those orders. People who are waiting for breakout will place a buy trade here. Price takes them and their stop loss will be somewhere here or below this point. If they have a big account, price comes down, seek internal range liquidity, continues upward. So price is continuously seeking to take out liquidity. So if price is moving to the upside, the external range liquidity to be targeting are previous highs, previous major highs. So it is targeting those highs above the range and those low below the range if it is a bearish market. So once you know that with level that price is targeting, you've already established your directional bias. So that will help you flow with what the market is doing and you understand which liquidity market is targeting at every particular time. Internal range liquidity refers to those levels that exist inside the trading range. External range liquidity exists outside the trading range. Previous swing highs and swing lows, any level outside those swing highs and swing lows are external levels. Internal range liquidity are those levels that are inside the current range, between the major highs and major lows. Between the major highs and major lows. So those levels that are inside the current swing range that we have, this is our range high and our range low. So every level that is inside this range is called internal range liquidity. So what price does is that it seeks internal range liquidity, picks entry, and continues to seek external range liquidity. The cycle continues, seek internal range liquidity, external range liquidity. So every level that is inside our current trading range is called internal range liquidity. And these levels are fair value gaps, order blocks, minor swing highs and swing lows, equal highs and equal lows. These areas hold liquidity within the current trading range. The area holds liquidity within the current trading range. So the key idea for price movement on the chart, every time you're looking at the chart, price is moving from external range liquidity to internal range liquidity and back to external range liquidity. This is how the market balances itself. So while external range liquidity gives us the target of price, internal range liquidity gives us entries to target those external range liquidity. So if we're in a bullish market drive, price is seeking swing highs, previous highs as targets, is going to do a pullback into internal range liquidity to gather entries, then push back up to external range liquidity. So let's quickly break down some of the major components of internal range liquidity. Fair value gaps, these are areas where price moves very fast, leaving inefficiency behind, where price often returns to these areas to rebalance itself. When we're talking about fair value gap, is created by 3 candlesticks, movement of 3 candlesticks. So if we get a candlestick move up like this, 1, 2, 3, and we have our wicks. So fair value gap is the gap, is an imbalance between the first and the third candle highs and lows. So this high of the first candle and the low of the second candle, is the gap between them is what is called fair value gap. The gap in between them is what is called fair value gap. This is an imbalance, an inefficiency in the market where price has to pick orders for entries, then move to the upside. So if you are in a bearish movement, the same thing applies for a bearish movement, 3 candlestick movement to the downside, 1, 2, 3. The gap between candle 1 and candle 3 is what we call fair value gap or imbalance. Price has to fill it, then move to the downside. That is how we spot fair value gaps in the market. 3 candlesticks will have to form the gap in the market, the first candle and the third candle, where for a bullish fair value gap, the distance between the high of the first candle and the low of the third candle. Just draw a line, or you put a box to differentiate those areas. That zone is called an inefficiency. Price was supposed to come down like this, but it didn't. It stopped halfway, then moved up. That's fair value gap. We'll see the examples on the chart as we progress. The next is order block. These are the last or bullish or bearish candlestick before a strong move. The last bullish or bearish candle before a strong move. Institutions often place orders there to stack orders. They will come back and fill it, then move back up. So if we have a move to the upside, that move should break structure. The move should break structure. If we have a move like this, we now have the last bearish candlestick. Get a last bearish candlestick. Then the next candlestick we keep having becomes green candles. Then we break structure to the upside. This whole red candle here is what is called a bullish fair value gap, because this is where buyers came in and displaced sellers. Price comes down into the order block. This is an order block, bullish order block, the last bearish candle. If the market is bullish, then picks it up. If the market is bearish, the last bullish candle is the order block, where you draw your order block from, the last bullish candle. So we have a market drop, break of structure, the last bullish candle that is at this spot. It can be 2 bullish candle, can be 1. Price will come back into it. Then we have the move to the downside. That's order block. Equal highs and equal lows. We'll illustrate that on the chart. equal highs and equal lows. These are particularly significant as they often have a concentrated order of stop loss. Let me just give a drawing for you to see. If price is moving to the upside, this is our current range. On lower time frame, price moves like this. It doesn't move in a straight line. Got to this point. Equal lows, previous swing lows. All these are liquidity, internal range liquidity. That price can come back, use any of them as entry levels to break the external range liquidity high, to target the next internal range, give us the new range. We target the next internal range and we continue to the upside. So let's look at some examples on the chart. Internal range liquidity. Price has given us a move to the upside, breaking previous highs. So if we look at this movement, we'll see that there is a gap here already. This can be caused by news or the weekend that price didn't trade and there was an information that happened that price couldn't print on the chart. Then we market opened, we have the move to the upside. So if we can also see these points, candle 1, candle 2, and candle 3, there's a gap. This is the high of candle 1 and this is the low of candle 2. This is a fair value gap. Price has to fill it, then move back up. So price coming down to fill this void here, this imbalance. This is a gap 2, is an imbalance, and we have a move to the upside. Price will seek internal range liquidity to target the next external range, which is this high. Price has taken out the high. We've gotten a new range. This is our new trading range. And if you look at this movement, price didn't move in a straight line before it took out that high. So we have a low here. So price reacting to this point, picking liquidity from here is not just random. It's because there's an internal range liquidity here, a previous low in the movement to the upside. There's a fair value gap here also. The distance between this candle and this is a fair value gap. Price tapping at the top of the fair value gap. This is a previous internal range low. This is also a previous internal range low. So price is seeking internal range to target external range liquidity. Price seeks this level and moved up, taking down this. This is our range high now, and this is our range low. We had a pullback, and there's a fair value gap here. There's a fair value gap here. This is the last bearish candle before we get a break of this structure. So this is an order block. So any of this level can act as a reaction point for price to move to the upside, internal range liquidity. That's the cycle. Price seeks external range, comes back to internal range liquidity to seek the next external range, which is the previous high. So for this pullback, after price has taken out this and given us a new trading range, price reacted from a fair value gap, and we had a move to the upside. We had a new range low, a new range high. Yeah. Price seeks internal range liquidity. We have a fair value gap here. If we scale down to a lower time frame, we'll see that there is definitely a double low here or a low point for price that price had to react from. So price is seeking every movement in price. We are going through the cycle of external range liquidity back into internal range, seek the next external range. So if price is bullish like we've seen here, price is targeting external highs, external range liquidity, that is the previous swing highs. It's targeting them. And it has to seek internal range liquidity, fair value gaps, order blocks, equal highs or equal lows, or swing highs or swing lows inside the internal range. So everything we are doing on this course so far, market structure, Fibonacci, premium and discount, now internal range liquidity, will help you streamline levels where you should anticipate orders to take entries from. So if price has given us a new leg, we draw our Fibonacci, we have discount zone. So we are looking for price to seek internal range liquidity that are within the discount zone. So if a Fibonacci level now aligns with a fair value gap, an order block, a previous swing low, or equal highs or equal lows, that's a confluence. That's telling us that that level will be a strong level for us to seek entry for the next move to the upside. So applying Fibonacci premium and discount to an internal range liquidity to price movement, it will give us a solid foundation to always wait for entries and we don't chase the market. So price has given us a new range here. We are going to look for our internal range liquidity levels, draw our Fibonacci, and wait for price pulling back into discount to any of those internal range liquidity levels for entries. If they align with the Fibonacci level, good confluence, moving average, good confluence, will take price back to the upside. So that's internal range liquidity and external range liquidity. So putting them together, combining internal range liquidity, market structure, Fibonacci, premium, and discount, first thing you have to do, you have to identify our current trading range. We identify our current trading range. If the market has given us a bullish break of structure, this is our current trading range, the swing high and the swing low. Then we mark our external liquidity, which is the swing high and the swing low. We use our Fibonacci to get our discounted price level, and we mark out those internal range liquidity levels that are inside the discount level. After we've drawn our Fib, we'll see the level that aligns and confluences with those internal range liquidity, and we wait for the pullback for price to get into any of these levels and react for entries. Then we move, continue buys to the upside. To target, first target will be the swing high. Then if there's another previous swing highs up here to the left, will be the next target. So this will help you remove guesswork and emotional trading. You stop chasing price, you stop forcing trades, and you start following price with intent. So let's wrap it up with this. The market is not random. It moves with purpose. And that purpose is to seek liquidity, either internal range or external range liquidity. So once you understand where these levels are, where this liquidity are lying in the market, it will give you clarity and improve your trading massively. So if this video has helped you in any way, make sure to like, share, and subscribe. See you in the next video. Thank you.